Nobody wants corrections, but this is not the end of an expansion. This is not the risk that we faced in 2018 when the Federal Reserve was tightening monetary policy with two different levers. This is the bond market just negotiating with the stock market to find a new equilibrium. We value every asset relative to interest rates, the opportunity cost of taking less risk and still earning a return. The bond market, again, was very poorly priced for a big economic recovery. That recovery is being driven by vaccines, the end of COVID. It's going to be driven by another very large stimulus. But who will pay for that stimulus? Will the Federal Reserve raise the amount of its bond purchases even further? Probably not. So what happens? We've got to, again, use some real resources to pay for a stimulus. The economy recovers, the yield curve steepens. All of this is very normal. But any asset that became overpriced for an extra low interest rate, for a crisis low interest rate, that's what's vulnerable to some correction.
So obviously we're seeing these yields rise. In your mind, what does that signal to investors, and what does it mean for the equity markets, and even longer term, what does it mean for the bond markets? I think a lot of people are watching that 10-year, especially people who are still thinking about refinancing their homes.
Well, at this level, we're not in any danger of creating some big valuation problem for equities. We do have to live at the moment with the greater uncertainty about the range of interest rates. How do we discount these cash flows when implied volatility, when the possible range for the bond market is uncertain? We create greater uncertainty in other asset classes, in every other asset class. But let's just be clear here. The Fed is going to be on zero through next year. We have yield curve steepening in every early economic recovery. That's going back even long before the 40-year track record that we've had of falling bond yields during most cycles. And it's really just the signal, the same underlying symptom of a recovering economy is going to have some upward interest rate pressures. It's going to bring up inflation expectations to some degree. Now, the extra wrinkle on this is borrowing a lot more money for a stimulus. That will be spent in the economy. That'll be spent. It'll pad corporate revenues. So all of this is generally good for stocks and negative for bonds, but the bond market is still going to have a toll. So coming into this year, in our outlook, we expected double-digit earnings gains and single-digit returns for stocks because of rising interest rate pressures at the long end of the bond market. Seems to be what we're going to get. The reason to just stick through this is that the coming year, we're still expecting in 2022, 12 to 15% EPS growth.
So, Stephen, you're saying that these rising bond yields are a signal that the world's biggest economy is ready to get rolling. But you also say you're overweight on Latin America and emerging markets. So how do you justify both things at the same time if this economy is ready to roll?
Well, it's about what happens next, right? Latin America is extremely beaten down relative to other cyclical trades that we've done. For example, last April, we added an overweight to small cap U.S. stocks. They rallied up 90%. We've trimmed some. Still think that there will be returns. Latin America rebounded, but it's far less complete. If you take a look at the COVID shock, it is just far more profound and lasting there. They're going to be later with vaccines. So do you want to think about 2022 with a part of your portfolio? Not what's performing well now, but what still has the capacity to perform well. Brazil's currency, for example, is down 20% versus the US dollar simply because of COVID. And then there are other reasons, but it's down more than that. So these are the reasons why. Again, you have to position a portfolio for what's next. Last year, as we hit those crisis lows, it was time again to position for a recovery. And there are still some areas of recovery, of rebound that have not been priced in yet.
Shepard Smith here. Thanks for watching CNBC on YouTube.